Have you ever tried to look at a company's financial report? I mean, it can feel like you're staring at this giant wall of numbers. It's confusing, it's intimidating, and it feels almost impossible to make any sense of it. But what if you could cut through all that noise? Well, that's exactly what we're going to do today. We're going to put a company, PPG Industries, through a full financial checkup. So let's get into it. I want you to think about this like a doctor's appointment for a company. We're not just going to look at one single number. No. We're checking its vitals, we're going to run some tests, and we'll look at its entire history to build a complete picture of its health. And this financial physical is how we're going to diagnose its strengths, its weaknesses, and its overall condition right now. So here's how our checkup is going to go down. It's a clear 5-step process. We're going to start with the basics, then we'll dive in and check the heart of the business, its profitability. After that, we'll review its long-term performance history, check its financial stability, and then finally, we'll put it all together for the final diagnosis on its current valuation. Okay, first things first. Just like when you go to the doctor and the nurse takes your height and weight, we need to get the basic measurements of our company. This just helps us understand its size, its scale, and its place in the market. So our very first measurement is market capitalization. And at over $24 billion, this tells us right away that PPG is a large, established player. I mean, this is not a small startup we're talking about. It's a real heavyweight, a company with a significant presence. Next up, we take its pulse by looking at the stock price. Right now, it's trading near $110. But here's what's interesting. That's almost 18% below its 52-week high. And this gives us our very first clue. It tells us that while this is a huge company, its stock has definitely seen better days over the past year. All right, with the basics covered, it's time to look under the hood. We really need to know if the company's core business, its engine, is running efficiently. In other words, is it actually any good at making money? To figure that out, we're going to use a key metric called return on equity, or ROE. And here's what that means in simple terms. It tells us how much profit the company is generating for every single dollar of shareholder money that's been invested in it. It's an incredibly powerful gauge of efficiency. So what's PPG's ROE? It's sitting at 19.85%. Now, to put that in perspective, generally anything over 15% is considered really good. So this is a very strong vital sign. It shows the company is highly effective at turning investments into actual profits. And get this strong number, it's actually getting stronger. You can see its current ROE is noticeably higher than its 3-year average. So this isn't just a healthy engine, it's an engine that's been tuned up and is running even better than it was before. And other tests are confirming this diagnosis. You've got a solid return on invested capital, you've got strong profit margins. They all point to the same conclusion. The core business is fundamentally healthy and profitable. A healthy engine is great, for sure, but we also need to look at the patient's medical history. How has it performed over the long run? Has it been a picture of health, or are there maybe some chronic issues we need to be aware of? Well, the company's total return journey tells a really fascinating story. If you look at the last decade, it delivered a positive return. But zoom in on just the last 5 years, and whoa, you see a really rough ride, a loss of nearly 30%. And yet, in just the most recent year, it started to bounce back again. And this slide right here perfectly illustrates the central conflict. Over 20 years, PPG has been a phenomenal performer. I mean, delivering a staggering 432% return. But the last 5 years have been a major, major challenge. So what this tells us is that we have a historical champion that has recently fallen on some pretty hard times. So, given those recent struggles, you have to ask, just how stable is the company's foundation? And maybe just as important, how has it been treating its owners, the shareholders, through these tougher times? A key test for stability is something called the debt-to-equity ratio. At 0.92, PPG has less debt on its books than equity. This means it isn't overleveraged. It relies more on its own resources than on borrowing. That is a fantastic sign of a prudent and stable financial structure, a really solid foundation. And now for what might be one of the most remarkable stats in this entire checkup. PPG has increased its dividend payout to shareholders for 54 consecutive years. That's right, 54. That makes it what's known as a dividend aristocrat, a really rare class of companies with an incredible track record of reliably rewarding its investors, year in and year out, through good times and bad. And you might be wondering if this is a strain on the company. Well, the payout ratio shows it's only using about 40% of its profits to pay those dividends. That means the other 60% is being kept and reinvested back into the business for future growth. So this reward to shareholders isn't just consistent, it's also very sustainable. Okay, we've taken the vitals, we've checked the engine, we've reviewed the history, and we've confirmed its stability. It's time to put it all together for our final diagnosis. Based on everything we've just seen, is the company's stock currently priced fairly? To answer that, we're going to use a very common valuation tool, the price to earnings, or PE ratio. It basically tells us how much investors are willing to pay for each dollar of the company's earnings. And a lower number can sometimes indicate that you've found a bargain. And look at this. PPG's current PE ratio is just under 16, which is significantly lower than its 3-year average of over 22. This chart makes it really clear that compared to its own recent history, the stock is trading at a considerable discount right now. One common valuation model takes things even a step further. It compares the current stock price of about $110 to a calculated fair value, which is based on its expected future cash flows. And that calculation, it puts the fair value at over $120, which suggests the stock might just be undervalued today. And this gap gives us what some investors call a margin of safety. In this particular model, it's nearly 9%. This represents the potential discount between the current price and what the company might be intrinsically worth. Think of it as a potential buffer for investors. So, let's recap our diagnosis. We have a company with a profitable core, a rock-solid dividend history, and what looks like a discounted stock price. But it's also facing some pretty significant recent headwinds. And this brings us to the final question we want to leave you with. What does the next chapter hold for a long-term champion that's busy navigating short-term challenges?